Well, welcome to Chapter 4. Chapter 4's topic is analysis of financial statements. The topics we cover are ratios. We'll look at ratios from all different angles and get a handle on what they mean, what they tell us, and so on. And so they start us out with a small company called DeLeon, and we're looking at 2 years of their financial information on the balance sheet. And you can see here in the 2019 to 2020. And 2020 is an estimate. That's why the E is there. But you can see a few things here. Their cash position will go up. Receivables will go up. Inventory will go up. CA means current assets. FA means fixed assets. Depreciation. And you kind of just see the changes between the 2 years. They then show us the liability and equity side between 19 and the 20 estimate. Payables will go down a little bit. Accruals go down. Notice that notes payable goes down quite a bit. They're paying off some debt. Long-term debt, same thing. They're paying off some debt. Common stock goes up quite a bit, and what that tells us is that they probably issued stock. And we can prove that in just a little bit. And then retained earnings goes up, and if you can recall that retained earnings goes up when a company has net income. Net income makes that number go up. On the income statement then, between 19 and 20, you can see 19 was not a good year. We had a net loss. You can see that down here. So good news is they're projecting some changes. They're projecting that revenues will go up and cost of goods sold will also go up, but thankfully not in the same amount as revenues. So therefore they'll have some profits. So EBITDA is earnings before interest, tax, and depreciation. Then after depreciation, we subtract that out and we get EBIT, earnings before interest and tax. We subtract interest to get EBT and so on. So the good news is they're positive net income in 255,774. And one thing to point out too, remember that they paid off quite a bit of debt between the years, and that's why their interest expense has lowered. They've reduced their interest expense. Just some data about them. They've obviously sold shares of stock, 150,000 shares. EPS is earnings per share. It's the amount of net income divided by the number of shares. Thankfully, that's now positive. DPS is dividends per share. It was 11 cents, now it's 22 cents, and stock price went up significantly, and these payments were not changed between the 2 years. So what ratios do for us, it allows us to do comparisons or what you might call benchmarking. It also helps us understand what are the strengths and weaknesses of a company's financial position. Ratios are best when they're compared to something. You can compare a company's ratios to itself over time, kind of like a trend analysis. You can compare yourself to a key competitor. You can compare yourself to an industry. What are the industry averages of the industry that I'm in? All of those will tell you a story and give you some information about your company. There's 5 major categories of ratios. You can see what they are right here, so we'll dive into each of these in just a little bit. And your chapter, I should mention, has all of these explained very well. So it's good to read through your chapter because this stuff will be there. It will be explained for you. And the first 2 ratios right here, this is for this company called DeLeon. We have the current ratio and the quick ratio. It explains what the ratios, how to calculate them here. And ratio calculation is not hard to do. It's just a matter of knowing the formula and plugging in the amounts to get the answer. And so that's not going to be challenging. And the authors of MindTap know that. And so they'll kind of make you what I call back into answers sometimes. They'll give you, they'll make you solve for a current or some portion of this formula instead of just giving it to you. You have to solve to figure out what current assets would be or what inventory would be and so on. So there's lots of little things that they do to kind of make you back into the numbers. But what the ratios are is pretty straightforward. So just kind of be aware of that. And I should mention that in your chapter, they're on page 129 of your ebook, and that it would be section 4-9 of your chapter 4. So section 4-9, page 129, you'll find a nice list of ratios there. If you could print that list out, that'd be helpful to have in front of you as you do your homework. But if you just have those ratios with you, that'll go pretty far to help you do the homework. So the current ratio, the quick ratio, they're helping us understand the liquidity of our company. And they're going to what they do next is, after we compute the ratios, what they like to do then is talk about what do the numbers mean. What's the trend showing us? Industry is over here, and then we've got a 3-year trend for our company. And you can see 2019, as you can tell, was not a good year. We had net loss right here. Their cash position, wasn't very good, and so on. So we can see there were some issues, some problems in their 2019 numbers. The 2020 numbers have definitely improved, and we're just seeing the 2018 ratios for the first time. So you can see here that their ratio, the current ratio is still below industry average. The quick ratio is below industry average. The good news is, 2020 is much improved over 19. Kind of got us back to where 18 was, but all the numbers are still below the industry average. And inventory turnover helps us understand how quickly does our inventory turnover, in terms of, imagine that our store was full, we emptied it, we filled it again, we sold it, and so on. You can kind of see that just helps us figure out how quickly do our goods sell. How often do our goods go out the door to our customers. And as a retailer, you want high turnover. That's absolutely what you need. The higher the turnover, the more you're selling. And you can see for them that the trend is negative, unfortunately, and they're well below industry average. So, they might have old inventory, poor inventory control, and they're actually, forecasting a downward trend between 19 and 20. DSO is days sales outstanding. Basically the number of days after we make a sale before we receive the cash payment for that sale. So DeLeon, they're manufacturing goods. They sell those goods to a customer, and the customer then buys them on account like another business. And then on average, the customer pays us in 46.44 days. Now, we don't know what the credit terms are. The credit terms for most businesses are right around 30 days. So imagine if the credit terms were 30 days and our customers pay us in 46 days, you can see there's a problem there. And we want that to be as low as possible. The quicker we get paid, the quicker we can use that cash to pay our bills and so on. So they're showing us the trend, and you can see the trend is not good. It's actually getting worse over the years, and it's significantly higher than the industry average. So we're collecting too slowly. We've got a poor credit policy. We're not giving credit to the right customers, or we've just trained our customers poorly. We just never given them consequences for paying us late. So we need to rethink our collections process. Okay, then fixed assets turnover and total asset turnover. Basically, they're measuring how efficient are we at using the assets of the business to earn $1 of sales. Okay, so basically just, think about why businesses acquire assets. Assets are economic resources, things that the business acquires to help us make sales. So you want to efficiently deploy assets to gain sales. And so the better you do that, obviously, the more profitable you ultimately will be. So let's take a look at our numbers and look at the trends. And you can see the good news here is we're actually above industry average. Now, we know that 19 wasn't a very good year. And for the fixed asset turnover, the good news is 20 is going to be an improvement. Not as good as 18, but still above industry. For total asset turnover, though, you can see is still declining downwards. And we do have a lot of current assets. We have a lot of receivable and a lot of inventory. So remember that our inventory ratios were low. They weren't very good. Inventory turnover was low. We have a lot of inventory, and the day sales outstanding ratio wasn't very good. We have too many receivables, and so when you go and you look at the total asset turnover ratio, those come into account, and those amounts being very high negatively impacts the total asset ratio. Debt to capital is basically what's the proportion of debt to total assets. There's kind of a magic number there. If you have too much debt, that can be bad. It's okay to have debt as a business. Interest expense is a tax deduction. So there's still reasons to have debt as a business. but too much debt obviously would not be a good thing, so you got to be careful about that. And then we have some the debt to total inventory capital ratios here. You can see for them, they in 2018 it was just above industry. In 2019 they had a lot of debt, and remember they paid off quite a bit of debt in 2020. They issued stock and used that cash to buy down some debt, and so that obviously brought this number down in 20. And TIE, times interest earned, is the TIE ratio. That's one right down here. It's your EBIT divided by interest. You're looking for a multiple of interest. By how much more earnings do you have than your interest? So we've got 5 times more earnings than interest expense. And you can see that the good news is it's improving, which makes sense because we paid off debt, which means we have less interest expense. But it was negative in 19. That's never a good thing. But every year has been below industry. Good news is 2020 is obviously trending the right direction. Then profitability ratios, your operating margin, for every dollar of sales, how much profit do you earn on that? Basically think of it like this. My EBIT, earnings before interest and tax, so before I pay interest expense, before I pay taxes, for every dollar of sales, I basically get just over 5 cents of EBIT. And my profit margin is my net income. So after every single expense is covered, just saying for every dollar of sales, I have 3.7 cents of net income. And my earnings power is my EBIT divided by total assets. How efficiently am I using my assets to earn EBIT, which is kind of like your operating profit. And we'll trend those numbers out here. And kind of the same story as some of the other ratios. 2018, every single ratio here was below industry average. 2019 was just a really bad year, especially on the profit side. All these are measuring profitability. We had net loss that in 19, so they're all negatives. Good news is 20 is rebounding, coming back, but we're still below industry average. So good news is we're trending the right direction. Bad news is we still have some work to do to get closer to industry averages. Okay, and I've kind of mentioned pretty much all of these before, so I've already walked you through this, but you can definitely read it on your own if you would like to. And then a few more ratios. Now we're looking at returns, so ROE, ROA, return on invested capital, and we're just trying to figure out our net income compared to some other measurements. So net income to total assets, return on assets, ROE, net income to total equity, 13%, and then ROIC is return on invested capital, and it's your EBIT times 1 minus T, and T being taxes, and then your invested capital is all of your equity and all of your debt together. So equity plus debt equals your invested capital. And then you can see here the trends for those 3 ratios. 2018, they're all below industry average. 2019, with that bad year we had, everything's negative. And 2020, thankfully, things are trending up, but still below industry averages for what we're looking at. So we're trending the right direction. We still have work to do. That's kind of the basic story here as you look at those. So the nice thing then, once you do that initial ratio analysis, we're looking at the 2020, projections, and we're looking at, if we looking at 19, we're looking at 20, we expect great things to happen. And then what you should do with ratios is kind of sit back and go, what if? If I do this, then what? If I sell stock and pay down debt, what does that do to my ratios? Those are the kinds of things that businesses should always be looking for and looking at. So it says here, if assets are constant and debt increases, that means equity goes down. Interest expense increases, which leads to a reduction in net income, and ROE declines because net income goes down, and ROE may increase or decrease. So it just basically says if we take on more debt, how does that impact ROA and ROE? Because those are major ratios that investors look at really closely. They care deeply about both ROA and ROE. Now, ROE itself, while it's a very good measurement, and as I mentioned, investors look at that one closely, you can see here it does not consider risk. It does not consider the amount of capital invested to earn a certain return. So ROE might encourage managers to make investments that don't benefit shareholders, that more have an impact on the short term and not the long term. So there's other measures that can be used to measure better performances. EVA is called economic value added, and that's one alternative to ROE. Then a couple other ratios, and this would be for a corporation that's publicly owned. A private company would not be able to do these. Price to earnings and market to book. So price is the stock price divided by earnings per share. That gets you what they call the multiple of earnings. So basically, I'm willing to pay, I'm basically paying $12, $11.90 for every dollar of earnings of my company. Okay, and the more profitable a company is, and the better the outlook is for a company, the higher that number will be. Then market to book is comparing the market price to the book value. Remember that book value is the balance sheet equity number is book value divided by the number of shares of stock. So that's a book value. So market value should be higher than book value, and the higher that number is, the better the company has performed, is one way to think about that one. Okay. So those ratios there, and again, you can see, kind of the same old story. 2018 was below industry, 19 was bad, 20 is getting better, but still below the industry averages. And pretty much explained this one, so we'll skip that one. I've already talked you through it. And then the EVA EBITDA calculations. And there's a case that I'm not requiring you to do, but I just want to kind of show you at least how to get to the EVA calculation. So an EV is enterprise value, and then we divide that by EBITDA, and then you can see how they kind of get down to some numbers here. And you can see in 2020, 7.7, in 19, 20, and 18, it was 6.3. The DuPont equation is kind of the last major thing we cover. And the DuPont equation was created by DuPont Chemical Company, by finance people there. And it takes the ROE calculation, return on equity, and it breaks it down into three categories: profit margin, total asset turnover, and the equity multiplier. And then right beneath that is the formula for each. So profit margin is net income divided by sales. Total asset turnover is sales divided by total assets. The equity multiplier is total asset divided by equity. And they call the PM, profit margin, they call it expense control. TATO, total asset turnover, the middle one. And then EM, or the equity multiplier, or debt utilization, is the last one. Okay, and then what they're going to do then for our company is just use those same numbers and break it down. What's nice about using the DuPont equation is you just multiply these three ratios by themselves, you get this answer on the right. And what's nice about doing it this way is you see which one of the three categories is causing your numbers to be good or bad, right? We've got the industry average at the bottom row here. You look at profit margin, good news is in 2020, it's trending up, and it's still below industry, but it's pretty good. Total asset turnover keeps declining, and it's definitely always been below industry average, so that's an issue. And then my equity multiplier, you can see here is, good news here, it's above industry for 20, but it could be improved. So I'm going to focus mostly on, if I'm trying to figure out ways to improve my ROE, the two big things are my profit margin needs to get better, and my total asset turnover ratio needs to get better. Those are the two I'm going to focus on. Okay, and then what they like to do is say, if we do this, then what? So the hypothetical here is, if we're able to reduce DSO down to 32 days, how would this affect the company? So let's just say we're going to work more closely at our collections and work with our credit department to get maybe a little bit more firm to get collections done at the right time. Get the collections done within 30 days, 32 days, as opposed to 44. You kind of think through what would happen if we did that. So under the old system, we were actually collecting at 46.4 days. And then we're collecting, and I should actually go back to mention the sales per day is the sales per year divided by days in the year. So 18,905.75 is my sales per day. So under the old ratio, I'm at 878. Under 32 days, I'd be at 604. So I would eventually have my cash balance would go up by $273,000. As I tightened up my credit and people paid me sooner, I'll have that much more cash. Now, keep in mind, there's an assumption there that I'm not losing customers, right? So one key is I get more firm with my collections, but I don't alienate my customer, right? So I work very closely with them. I warn them. I say, I'm going to start giving you a penalty. If you don't pay me on time, I'm going to give you a chance to pay me on time before I give you the penalty, and da-da-da-da. But that's very important too. And so if we reduce receivables, what's that do? What could we do with the cash? How might the stock price and risk be affected, right? So with extra cash, we can do lots of things, right? With extra cash, we could buy back some stock, invest in the business, try to expand it. We can pay off some debt early. All of those things should improve the stock price. All those things would be positive signals to investors that should increase our stock price. Okay, so ratio analysis is never perfect. It's very good. It should always be done. The skill of looking at a company's financial statements, making comparisons over time, running some ratios, doing some benchmarking, trend analysis. Everybody should have those skills in business. Okay. It doesn't mean it's perfect though, because if you only see a company's financial statements, you don't necessarily have the entire picture. Okay. Now, also keep in mind that some companies are giant. They're huge. If you think of a company like Disney, they have several divisions. They own ABC, ESPN, movie studios, the theme parks, other TV channels, a cruise line, retail operations. The list goes on, right? If my company is, I'm Royal Caribbean Cruises, and that's all I do, and I'm comparing myself to Disney, can I only compare myself to their cruise line division? That's the challenge that I would have if I'm at Royal Caribbean, trying to compare myself to what Disney is doing. So that can make analysis tough sometimes. Also keep in mind with accounting, the GAAP accounting rules kind of give us a menu of potential GAAP principles that we can use. There are 4 different depreciation methods. There are different methods for accounting for on collectibles and things like that. And so if I'm comparing my company to another and we use different depreciation methods or we use different inventory accounting methods, that can make comparisons difficult. The biggest challenge you may have as you do ratios is this number good or bad? I don't know, right? Sometimes that's the challenge. And then it's hard to determine sometimes if the company's in a weak or a strong position. Also, when you compare yourself to an average, do you really want to strive to be average, right? The average performance isn't necessarily good. Perhaps we should aim for a higher standard than that. Seasonality can be a really big deal. Seasonality can definitely impact a company's numbers when we look at their numbers. If we're looking at quarterly numbers and it's a retailer that just got done with the Christmas season and we're looking at their quarterly numbers right after the Christmas season, they're going to look a lot better than they would in the first quarter of the next year, January, February, March, when sales would probably go down. Window dressing is techniques that companies can do to make the numbers look better, like right before they might obtain a bank loan, right before they might go public or issue a new round of stock. Companies will quite often undertake some accounting principles that might be a little on the edge, still within reason, but maybe on the edge of maybe not being good, and to try to make the numbers look better. Inflation may be an issue. Other things that ratios won't tell us is what percent of sales come from a certain product line, what percent of sales come from just one customer or a few customers, who's your major supplier? Do you have just one major supplier? Do you have several? Where do your customers live at? Are they all overseas? Are they dispersed throughout the country? There's other things that come into play that you wouldn't be able to find out by just looking at the financial statements. You have to do more digging, looking into the management's discussion analysis filings, looking at any news reports, any articles, things like that. Obviously speaking with people at the company too to see what they can give you. So ratio analysis is a great start, but it's not the end all to be all when it comes to understanding a company's finances. So with that, again, make sure you walk through the example in the chapter. Page 129 has a great list of the ratios. And then within MindTap, just be looking at the videos within MindTap. They do a lot of really good videos to walk you through how to do specific problems and give you examples. So just make sure you're looking at those. And I'm always a big believer, before you take a quiz or a test, always review the key terms at the back of every chapter. The key terms are chapter 4 on page 135. You want to take a look at those. And then remember that I give out answers to the review questions. There's always a big list of review questions at the back of every chapter. I've given you the answers for those. They're available. And just read those questions, read the answers. That gives you a good feel for if you understand the concepts of what's going on within the chapter also. And as always, if you have questions, just feel free to let me know.